This module will help you to understand the importance of planning for retirement and why starting to plan and save early will help you achieve your long-term retirement goals and objectives. Why should you save for retirement? The current average retirement age in Canada for public service employees is approximately 61. Based on today's life expectancy estimates, you could spend between 25 to 35 years in retirement depending on when you decide to retire. You need to ensure that you saved enough during your working years to cover your expenses during retirement. It is expected that this figure will increase in the future. Because people are living longer, they need to work longer to accumulate the funds necessary to fund their retirement. Let's look at an example. Someone who starts their career at age 23 and retires at age 61 would have worked 34 years and, based on current life expectancy, be retired for 25 years or more. What's important to note here is that 25 years in retirement is a long period of time. It's almost as long as the number of working years. Living longer is a generally good thing. However, this needs to be considered when planning for retirement to ensure you have sufficient savings to be comfortable in retirement for 25 years or more. When determining a person's life expectancy, actuaries look at the possibility of a person reaching a certain age and look at different life expectancies based on different ages. For example, the current life expectancy of a 60-year-old is approximately 87 for males and 89 years old for females. But if you reach age 80, you are expected to live to age 90 if you are a male and almost 92 if you are female. Life expectancy increases with age. An easier way to explain it is, the longer you live, the longer you're expected to live. For instance, by age 70, you will have added on an extra year to your average life expectancy. How much will you need? Based on industry experts, you will need approximately 60 to 70% of your gross pre-retirement income replacement in retirement to maintain a comparable standard of living in retirement. The 60 to 70% is a rule of thumb, and it might not be adequate in every situation. If you intend on traveling around the world, you may need more than 70%. Whereas, if you intend on spending more of your time gardening or reading and traveling less, you might only need 60%. The Sun Life member site provides many tools, including a retirement planner that can be used to project your estimated benefits. Within the planner, the same 60 to 70% gross pre-retirement income rule of thumb is used. You will need to look at your personal situation to determine which percentage aligns with your retirement goals and objectives. Will you have enough in retirement? This is a very important question to consider before retiring. First, you need to have an idea of the age at which you will retire. Age plays an important role in planning. For example, if you choose to retire at 55, you will have 10 years less of retirement savings and 10 years more being retired than someone who elects to retire at 65. To get an estimate of how much you will need in retirement, you need to determine what your spending needs in retirement will be. To help, we suggest you create a budget. A budget will help determine your total monthly expenses in retirement by estimating your fixed expenses, such as lodging, utilities, and food, as well as your discretionary expenses, such as social activities and travel. The Guide to Financial Planning for Retirement, published by Retraite Québec, is a good source of information and includes a budget template. You may also use the links from Revenu Québec and the Canada Revenue Agency to help estimate your net income in retirement. Where does your retirement income come from? There are 3 sources of retirement income. These are the building blocks represented by the basement, ground floor, and top floor of your retirement. The programs offered by the government, the Quebec Pension Plan, QPP, and Old Age Security, OAS, will represent the basement. Recent changes to QPP contributions will gradually increase the income replacement to 33% by 2065. QPP contributions are being increased to provide a higher income replacement at retirement. OAS replaces about 12% for the average worker. Together, the government programs will provide about 40% of income replacement for the average worker. Employer-sponsored pension plans, such as the McGill University Pension Plan, MUPP, represent the ground floor. The MUPP, which will be covered in another module, will replace approximately 49% as a best-case scenario based on a pre-retirement income of $58,700 for a member who retires at age 65 and participated in the MUPP for 35 to 40 years. If you earn more than the average wage, the MUPP will replace less than 49%. However, if you retire at age 55, the MUPP will not replace 49% as you will have 10 years less of participation. Also, since QPP is only available as of age 60, between age 55 and 60, you will only have access to the reduced savings in your employer-sponsored pension plan and your personal savings. To recap, government benefits for the average worker will provide about 40% of replacement income. In the best-case scenario, the MUPP will provide another 49%. Any shortfall to reach your ideal replacement income will need to be funded by your personal savings, the top floor. These personal savings can be registered retirement savings plans, RRSPs, or tax-free savings accounts, TFSAs, held with your external financial institution or the Group RSP or Group TFSA offered under the McGill University Savings Program. Now, let's talk about the impact of inflation in retirement. You have probably noticed that the cost of goods and services is rising, and a lot of items cost more than they used to. The reason is inflation. Inflation is defined as the rising cost of goods. Over time, your purchasing power will reduce because goods are costing more. For instance, if you have an income of $50,000 today, over a 25-year period based on an assumed inflation rate of 2.5%, you will need $92,697 in order to purchase the same goods that you did 25 years earlier with only $50,000. Over a 25-year period, it almost doubled. When planning for retirement, inflation needs to be included as a factor. Let's take a closer look at government benefits, the Quebec Pension Plan, and Old Age Security. This is a snapshot of the Statement of Participation that is issued by Retraite Québec for the Quebec Pension Plan. They are issued starting at around age 40, and regular updates are sent. On the Retraite Québec website, you can create an account to have access to your Statement of Participation. The Statement of Participation will provide you with two things: the benefit that you have accrued today, which would be payable at age 60 or 65, and the benefit at age 60 or 65 if you continue to contribute on the same basis. The QPP is a contributory plan for all employees working in Quebec over age 18 and earning more than $3,500 per year. The benefit that you receive is based on the contributions made, the earnings on which you made those contributions, and the age at which you retire. The benchmark for retirement age for the QPP is 65. The second page of your Statement of Participation will provide all the employment earnings on which you made QPP contributions since the age of 18. It will include any amounts made to the Canada Pension Plan, CPP, which is basically the same plan as the QPP, but for contributors outside of Quebec. There is a cap on the amount of earnings on which you make contributions to the QPP in any given year. This is called the Year's Maximum Pensionable Earnings Limit, or YMPE limit. Once you reach that limit during the year, QPP contributions stop for the remainder of the year and resume the following year up until the new limit. Within your statements, earnings which are capped at this limit will be indicated with an asterisk. The maximum QPP amount at age 65 is displayed on this slide. To be eligible for this amount, over your working years since age 18, you would have needed to contribute to the maximum amount permitted to the QPP up to the YMPE as noted earlier. According to a Retraite Québec survey, only 42% of Quebecers receive the maximum amount. This may be due to periods where QPP contributions were not being made or where you did not contribute the maximum permitted amount. Reasons could include staying home to raise children or going back to school. You can start receiving QPP as early as age 60. If you choose to receive it early, it will be reduced by 0.6% per month before age 65. If you choose to postpone receiving your QPP to age 70, it will be increased by 0.7% per month. Old age security is different than the QPP in that you don't contribute to it. The program is funded through federal taxes. Everybody in Canada, through their federal taxes, will fund the Old Age Security Program. As with the QPP, the benchmark is age 65. However, for OAS, you can't elect to receive it earlier than 65, but since 2013, you can defer OAS to age 70, and a 0.6% increase per month will be applied. Since OAS is non-contributory plan and funded through taxes, it is subject to a clawback. If your annual income after retirement is above or beyond a certain threshold, OAS will be partially or fully clawed back. To determine the amount of clawback, your income from the previous year is determined and the clawback, if any, is applied in the following year. These figures increase every year and are available on the Service Canada website. This slide summarizes when you can start receiving retirement income from the different sources. The minimum age to receive retirement income from your McGill University pension plan and RRSP holdings is age 55. The Quebec pension plan or Canada pension plan is from age 60 but reduced, and OAS is as of age 65. You may start using your own personal savings at any time. You may elect to work part-time to supplement your retirement income, being cautious that it will not reduce your OAS through the clawback measure. When can you retire? There is no mandatory retirement age in Quebec. In the MUPP, we refer to your normal retirement date as the last day of the month in which you reach age 65. Age 65 is the benchmark used in the industry, whether it relates to government programs such as QPP or OAS, or employer-sponsored plans such as the MUPP. In the MUPP, early retirement is available as of age 55. You can elect to retire but delay settlement of your pension holdings. Under the Income Tax Act, conversion of your MUPP and/or any RRSP holdings, which have been tax sheltered during the accumulation phase into a retirement income, must occur no later than December 31st of the year in which you reach age 71. If you choose to continue to work after age 65, regular employee and university contributions to the MUPP stop. You have the option of making additional voluntary contributions by payroll deductions and receiving an immediate tax relief at source. There are a few steps to take to retire. Administrative and support staff have to provide notice in writing to their immediate supervisor. Academic staff should follow the guidelines provided in the regulations on the retirement of academic staff or contact the Academic Personnel Office. Once your retirement is confirmed, it will be coded in Workday and automatically sent to Sun Life for them to issue a settlement package. This package will provide you with all the detailed calculations and the different options available to you. It will also be posted under Accounts, Transition Quote on the Secure site. Sun Life cannot issue your settlement package until they receive your last contributions up until your retirement date. As a result, there will be a lag between when you retire and when they will be able to issue the settlement package. On average, depending on pay schedules, this usually takes about 1 month to a month and a half. Here are some links on where you can find more information on the topics covered in this module.